Imagine for a minute if you went to sleep tonight, when you woke up, you generated additional income. That's exactly what we're going to be looking at in today's video. Now, generating consistent, safe income, really reliable dividend income comes from stocks, comes from investing. And in today's video, we're going to be looking at two high yield ETFs to really use during retirement. Now, of course, when it comes to retirement, you are on Social Security income, you might have a pension, might have a 401k plan, but there is a portion of money that essentially is in ETFs, exchange traded funds, that I would put into the passive income. That way you have the ability to supplement that Social Security income. And of course, getting some of the dividends out of the portfolio you have can not only just give you the dividend income that you're looking for, but it also means that you're not touching your original principal when it comes to your investment itself, which of course can be beneficial because not only are you taking off some dividends, but if you see some stock growth as well, and again, these two really did see some stock growth, but I want to look at them because they are two ETFs that I have not looked at before. And of course, with a steady stream of income, it makes a really big difference with minimal price movement. And the first ETF we're going to look at on this list is the iShares International Select Dividend ETF. Ticker symbol on this is IDV. Now, when you start thinking of dividend ETFs and really looking at the return, thinking of your CDs, thinking of your high yield savings accounts, it needs to be north of 5% to really make it worth your while to invest in some of these dividend ETFs. And of course, also poised for a little bit of growth. Now, this one does offer a 6.7%, which again is pretty incredibly high for a payout for a dividend. And even if you looked at investing the dividends for a couple years up into the point of retirement, where you did need the income, because in comparison to that S&P 500, which pays out an average of 1.3, it is a target fund that is safe with international stocks and looking for diversification outside of the United States. So if you have a majority of your portfolio within the United States, you could definitely benefit from some of the international exposure. Now, this ETF specifically holds 100 funds, so it holds 100 companies within here. The largest holding is British American Tobacco, which is 4.8%. Also big names as the telecom giant of Vodafone and also Mercedes-Benz. So when you start looking at the ETF itself, holding 100, only 4.8% in that British American Tobacco. So you have some diversification in there. Now, of course, 31% of the holdings are financial stocks. So this you have to take kind of with a grain of salt because there is going to be some financial stocks in here. But of course, financial stocks, the financial market does have a lot of stability. When you think of banks and credit unions, financial institutions do have a lot of stability. Utilities in this one count for 16%. Communication stocks are another 12%. And they are the only three segments that do offer the double digit investment, which means that when it comes to investing in here, you automatically have diversification, which is very cool to see. The reason why we buy ETFs, and of course, most of them have an incredibly low fund expense ratio. Now, looking at the total returns on this, total returns over the last 5 years have been about 30%. The S&P total returns over the last 5 years is 100%. So take that again, kind of looking at the ability and being the investor, being the retiree that invests, prioritizing dividend income and stability in the stock market. This ETF could be a very good option to consider. But if you're looking for solid growth, that S&P 500 still does have a good growth, but you're not going to see the dividend income in there. And then, of course, looking at this fund specifically, the expense ratio on this is a 0.51. So it is a little bit higher when it comes to the expense ratio with this one overall. And the second ETF that we're looking here is the Pacer Global Cash Cow Dividend ETF. Now, of course, with the name of cash cow, it makes me think of high dividend. It makes me think of high yield. This one does pay 6.3%, so a dividend yield, pretty good. The expense ratio is a 0.6, so just slightly higher than we see in the international, but a majority of these focus on a different type of company than we see outside of some of the other ETFs. This Pacer fund focuses on companies that generate a significant amount of free cash flow, meaning that they are not your really heavy tech companies, free cash flow, and have the ability to pay dividends with that cash flow. So they're not seeing a lot of the reinvestment, a lot of the research and development. This is more of your really blue chip stocks that you see. Now, unlike the International Select ETF, This one does have US stocks and does contain a lot of those big dividend ETFs that we see. It also has 100 stocks. So the same as the last one that we looked at, this one does contain 100 stocks as well. And they're looking for two things when it comes to this ETF. High free cash flow and high dividend yield are really the two big things. Now, of course, this one has a holdings cap at 2%, which does a semi-annual rebalancing. So what that means is when you start looking at 100 companies, it has a 2% cap. So if companies over a 6-month period, really, let's say a company grows to 3%, they are going to take that company down to 2%. That means they have 100 companies, 2% each, which again, 100 stocks and the cap is 2%. So nothing is going to go over the 2%. Now, of course, some of these can be, a 0.1, a 0.5, a 1%. But of course, it is going to rebalance. With the rebalance, this keeps the risk down for investors even further. Now, the top two stocks in this fund are healthcare giants, Roche and Gildan Science, each accounting for about 2.3% of the total weight as it is now, until there is the rebalancing back to that cap of 2%. It has a really good stock, a really good mix of stocks in the funds, many sectors accounting for between 10 and 20% of the ETF's holding, including energy, healthcare, consumer staples, communication services, industrial. So overall, when you think of the return on this, pretty good. Diversification in here, pretty good as well. Over the past 5 years, the Pacer ETF has generated a return of 46%, which is better than the International Select Dividend ETF. But depending on the strategy, depending on exactly where you want to be with the dividend yield, could be really who of you to add both of these or either of these really to your portfolio. And again, when we think of the portfolio itself, and I always go back to this, the big thing that you want to do is you want to make sure, again, that you have kind of your your foundational, that is kind of like your VOO, that is the VTI, that is kind of the basis. There's a lot of them. There's a lot of foundation that are from different companies. So definitely let me know in the comments what you guys are picking up. Then, of course, you want a growth ETF, which is going to be the big one. That is going to be the mover and shaker, your 20s, 30s, and 40s, that you're going to see exponential growth. And the third one that you're looking in there is really the high yield ETFs or the dividend ETFs, which of course are going to produce that income that is needed during retirement to supplement Social Security, and making sure that you do have these in the 3-fund portfolio. And again, you can kind of play around with your percentages that you have within there. But of course, there are a lot of different options. So I really urge you to do your own research. Make sure you know what you're investing in and which companies you're investing in. And overall, personally, for me, I do not invest in international. I know the article right here from the Money Fool talks about 2 high yield dividend ETFs. That could be the very ideal investment for retirees. And again, if you're carrying a big bulk of your portfolio all within the United States, carrying all the S&P and everything that we have here, could be, good to put a couple percent in there. That way you do have a little bit of exposure to international. Financial advisors say roughly 10% should be in international. But again, that is really up to you and the risk that you do want to take. But all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.